Dave Lechtenberg, Ames, Iowa, contributor, ATI Pro Media.
Dave Lechtenberg, Ames, Iowa. Welcome to the show. What are we talking about today, Mr. Lechtenberg?
Well, let's talk a little bit about managing crop insurance.
I like that idea. And now we are at the end of December. We have all of January and then February. Tell me your thoughts on crop insurance.
Well, great product. It's been great for the American farmer. If they ever called and asked me, what are some things could change about it? If somebody from Washington called me, I'd say, well, the revenue per acre aspect of it be nice if we're going to use this product, that it would be a better product to manage price. And then the other thing would be, it'd be nice if we could just manage more months than just February and October. Both of those things, though, it's not like nobody in Washington ever thought of that. It's just that if you did those things, it would make the product, a lot more expensive. So we just got to look at it. It's a great product, manages it if you aren't going to have a yield, and let's figure out how we can make it work best for our own operation.
Sounds good. Let's get in the show. I know that people are going to be a little disappointed that when they think about where we were last year versus where we were this year. I also will go of the opinion and say I think crop insurance messed people up from getting forward sold last year. That's just my opinion. What do you think?
Yep, it does. It does, because of that fact. It's kind of presented as a way to manage price, and you look at it and say, hey, I've got crop insurance, so I don't have to make sales. But the reality of it is if you keep growing your yield higher and higher, your actual price protection per bushel drops. So you look at it today, I think a lot of farmers would say, hey, 512 December corn, if that's my February average, if that's my spring price on that, I'd be real comfortable with that. Our inputs are a lot less than last year, even though this price is a lot less. Our inputs are less. And so we could definitely work with that. But the reality of it is we got to hope that price, if we're just using crop insurance, we have to hope that price stays until next February as an average, until that month of February is done. So we want to look at what are some ways that we can manage some of these unsubsidized pricing periods. And crop insurance has a lot of what they call flex alternatives. I'm sure you've seen those, Tommy.
Absolutely.
Yeah, and they add pricing periods. They're just like the crop insurance, except now we're going to pick this month. It's an unsubsidized product. It's not something that the government is helping us pay for. So it's definitely more expensive. That's one alternative, one way to come in and add, bring in some things. But then again, you still have, it's a revenue per acre product. And you have to pick the months, either that or you got to pick all the months. So what can we use, from an option standpoint, and what can we compare cost with to that flex product? Well, the CME came out a couple of years ago with what they term as a short dated options, both puts and calls. Easiest way to explain that is if you went out and bought a new pickup and wanted insurance on that pickup for 12 months, you'd get a bill, you'd call your agent up and say, hey, what's it going to cost me to insure this pickup for 12 months? Or if you called them and said, hey, I want to insure the exact same pickup, but I only want to insure it for 3 months. Well, obviously the 3 months is going to be a lot cheaper than the 12 months. Well, that's all short dated options are. If I look at a March 24 short dated put option, it's simply an option based off a December 24 corn that expires with the March options, in other words, February 23rd. And you compare it cost-wise to a full season December 24th. Obviously the December 24th is going to be a lot higher, but there's still reasons to do it. If we're sitting here today talking about that 5/12 December futures price and wanting that as an average price for my crop insurance, we can hedge that. We can come in here and say, I'm going to buy a March short dated 5/10 put option. It's going to cost me somewhere between 11 and 12 cents. I'm going to get that bought. And now, between now and the end of February, not quite the end, February 23rd. So you're only managing the majority of February, but I think there's 4 pricing days that you won't be covering because it expires on the 23rd, but you're going to get a big chunk of it. And then come next February, either the price is going to be above 5/10 and this option is going to be worthless, but you'll take that because that means your spring price is even higher than the 512 we're looking at, or it's going to be something lower than that. And this put option is going to have some value. You'll have your spring price, you add the value of this, and you'll get your close to 512 type of protection. Does that make sense at all there, Tommy?
It does, and I think people are scared or cautious. Like, I'm having a hard time getting farmers to make a cash sale at 512. They're cautiously optimistic that we'll rally. The problem, Dave, is they also have old crop bushels.
Yeah.
We have to address each one of those situations differently. I can see why someone would want to be heavily protected with puts on last year's crop and start to get into these. If you didn't have as much of last year's crop, you might have a different time frame in view. So I guess the question we have to ask our clients or anyone watching this: how long are you? I mean, do you have a lot of
Mhm.
23 crop and nothing sold in 24? So it's really important to get what products right for the client. Unfortunately, if we find out coming in that January crop report that this crop's a lot bigger than we thought, the one being before, which I think they have it pretty much figured out at this point, but it's South America that's the wild card. If South America just plows in a ton of corn and America plants a bunch of corn, we're gonna have too much corn in the world, and that scenario is already starting to happen.
Yep. Yep, it is. And you hit on the most important aspect of this is there's not a lot of value to going out and covering managing all of 2024 crop if we don't have a good handle on what's going on in 23. If we don't have that crop managed at this point. Assuming that we're comfortable with where we're at, this
Mhm.
is probably a good product to come in. And you can pick a month. You can come in and say, well, I'd like to have those last 4 days of February. And so you can come out and say, okay, I'll do a April short dated, gives you an extra 30 days. Same 510 put's going to cost you a little bit more, between 14 and 15 cents, but you're going to buy yourself a little bit more time. And you can continue with this argument endlessly. You can come in and say, but then maybe I want a May short dated
Sure.
option because now that gets me through the March planning intentions report. And then you can say, maybe I want a July and that gets me through planting, et cetera, et cetera. You can continue to do that all the way till new crop, where you can come in and say, well, what about if I just did a December 24 option that manages my spring February pricing period? It also manages all of the summer, all of the spring, all of the reports. And on top of it, we can get through harvest and know exactly where our harvest is at. Well, you can do that again. A cost goes up. And so you just have to look at, from your operation, what makes you comfortable, what allows you to sleep at night. Where do I need to have my marketing from a protected standpoint that I can feel real good about where we're going forward.
Can I ask you a question? And
Sure.
it it's either pay 36 for the 510 now or pay 12 cents 3 times in a row. Is that correct? I mean,
Correct.
pay 12 cents, you could pay 12 cents, you could pay 12 cents. You may have a reason why you're doing that, or you could pay the money now. So to your analogy in the beginning of the show about the pickup, hey, I just want insurance on 3 months of my pickup. You got it. 3 months later, you're buying insurance again. But what we're trying to do is cover that gap up into where that crop insurance level comes. So I could see why someone would be very heavily hedged and protected up front with those March puts. And then when they get their crop insurance, reevaluate and move to a December. Is that correct?
Yep, exactly. It's kind of like anything else. You get the more you manage it, the more bang for the buck you get. So if you compare just coming out December 24, I'm going to spend 30 close to 40 cents for the 510. In comparison, you're probably going to spend the same amount doing it in three different moves. But the reality of it is now you've got some flexibility. What if we got to next February and for whatever reason corn's $6? So when you go to extend that coverage, you're going to basically, whatever put you would have bought is worthless, but you're going to be repurchasing a lot higher than if we went straight out to the 510. You'd be able
Sure.
to manage forward from there. So yeah, there's advantages, there's disadvantages. If the volatility goes way up, they're going to get more expensive when you buy more, but who knows where those are at. I think the biggest thing is let's manage risk one way or another. There's a
Right.
10 different ways to skin a cat, but let's find a way and start managing risk. And managing some risk is better than doing nothing at all.
Real quick about volatility, for those of you who don't know or didn't watch the 9 a.m. live show, corn volatility hit a 52-week low last Friday. In reference, Live cattle volatility hit a 52-week high. So volatilities for different commodities can be different. What we're saying is options are affordable, both the put and the call. It's because they don't think corn's going to move too much. You've lived long enough or farmed long enough to know. Don't listen to what anyone says. Just, whatever. If someone says market can't go up, it's probably going up. They say it can't go down much lower. It can go down a lot, much lower. And but right now, volatility is affordable in corn options.
Yep, very true. So yeah, so I think at the end of the day, let's have the conversation. Let's look at maybe we use some flex products that the crop insurance industry is offering. Let's compare them to some of the short dated. Let's call up your broker and say, hey, this is what I want to do. This is what's keeping me up at night. What can we do? What can we put together to make me feel better about my marketing for not only 2023 but 24 also?
Sounds good. There's a lot of choices. It's a quiet period, but I think it's also a good time to do this. I think everyone's kind of sleeping behind the wheel as we come into Christmas. Did you want to talk about that last slide or just skip to this?
Nope. That basically was just I probably talked right through that. That was just basically kind of reminding people to compare the two. Take the time to get comfortable.
Yeah, you're getting pretty good with the software. Could I talk a little bit about ATI Pro Media Live at 9?
You bet.
Every day at 9 o'clock, we go live on the Advanced Trading YouTube. We send out text or alerts. It's free. It's open to anyone. Tell a friend. We'd love for you to watch it. If you missed the show, you can catch it on Apple and Spotify. Of course, content like this will be classified as premium content for advanced trading clients or friends of advanced trading, etc. And we got a whole list of people who are going to be doing stuff like this. Our goal is to educate people. The Live at 9 show will educate you for free. You want stuff like this? We appreciate your business. Mr. Lechtenberg, you did well. You're clicking away here like you've done this 1,000 times.
Yep. Old dog, new trick.
You want to hear from the favorite Grisafi?
Yep, I do.
Let's close the show. See you tomorrow, buddy.
You bet. Thanks, Tommy.
Thanks for joining us. We're here every day, 9 a.m. Central. Don't forget to like and subscribe. We'll see you next time.